Palantir is handing the market a massive mathematical contradiction right now. We are watching a company print absolute record fundamental growth while simultaneously suffering severe multiple compression. The stock is cracking, sure, but the underlying business has literally never accelerated faster. Understanding where Palantir goes next requires us to completely detach from the noise and strictly follow the SEC filed data.
The raw paradox of Palantir's market reality is pretty striking. On one side of the ledger, the stock is pacing for its worst month in 5 years. Shares are down about 30% year-to-date, trading near $113 after touching highs of $207. Yet, structurally, the business itself just delivered the highest growth in its public history. Revenue is up 85% year-over-year, and they're generating massive cash flow with a 57% adjusted margin. You have a stock chart that's crumbling, juxtaposed against absolutely flawless business execution.
To anchor this explainer in reality, we have to look directly at the Q1 2026 reporting. Total revenue reached $1.63 billion. That is an 85% year-over-year jump, along with a 16% sequential increase. We're talking about the 11th consecutive quarter of accelerating growth, and the primary engine behind this massive print, it's the continued, highly aggressive acceleration of Palantir's U.S. business. This isn't just a slight beat, it's a fundamental shift in their revenue velocity. So, why the 30% decline in share price? You have to look at the math driving the valuation. Palantir has been trading at a staggering 67 times trailing 12-month sales. Historically speaking, any price-to-sales ratio above 30 has proven unsustainable in public markets. When a stock trades at a 67x multiple, accompanied by a trailing PE of around 150, there's zero margin for error. Sticky macro volatility and higher-for-longer capital costs act like gravity on these types of lottery ticket valuations, forcing a very violent compression. That valuation compression is feeding a very specific bearish narrative across Wall Street and retail trading platforms right now. The core thesis being circulated is that the current enterprise AI boom might just be an AI sandcastle. Michael Burry recently popularized this critique, suggesting the valuation is supported entirely by a hype narrative rather than durable, multi-year infrastructure spending. The bears are arguing that this next big thing bubble is already beginning to deflate. Deconstructing that bear case systematically, we find 4 distinct threats. First, a forward PE near 19.5 times demands absolutely flawless execution for years. Any slight miss gets heavily punished. Second, the market has had to absorb consistent insider selling concentrated right between the $132 and $160 price levels. Third, there's a distinct regulatory overhang internationally. A UK parliamentary committee recently labeled Palantir an unacceptable point of weakness regarding public sector dependency. And finally, retail sentiment has flipped entirely. Bearish posts are actually outnumbering bullish ones 8-8 on platforms like Reddit over a recent 30-day stretch. If you want bull versus bear stock analysis without hype, subscribe to Future Ready. Section 1. The Bull Case Reality, Unpacking the SEC-Filed Acceleration. Facing that bear case requires confronting it with the bull case reality. The whole AI sandcastle narrative directly contradicts the undeniable financial acceleration happening beneath the surface of Palantir's stock chart. When we move away from the sentiment and return strictly to the SEC-filed data, a highly robust picture emerges. The most critical milestone in this Q1 2026 report is the U.S. growth. U.S. revenue grew 104% year-over-year and 19% quarter-over-quarter, hitting $1.28 billion. This is the first time since the company's direct public offering that U.S. growth has exceeded triple digits. The U.S. segment now makes up a massive 79% of total company revenue, concentrating Palantir's business right in its highest growth environment.
Breaking down that U.S. segment reveals the actual engine driving the surge. U.S. commercial revenue skyrocketed by 133%. What this proves is that enterprise adoption of Palantir's artificial intelligence platform, or AIP, is not just some pilot program phenomenon. It's actively converting into massive, scalable revenue. Simultaneously, U.S. government revenue grew by 84% to $687 million. The company is successfully executing across both enterprise and defense sectors at the exact same time. All this operating leverage leads us to a frankly astonishing metric. Palantir's Rule of 40 score reached 145% in Q1, jumping 18 points from just the prior quarter. For context, the Rule of 40 combines revenue growth rate with adjusted operating margin. Hitting 145% absolutely shatters typical software industry benchmarks. This is a level of operational efficiency currently matched only by foundational AI hardware companies like NVIDIA, Micron, and SK Hynix.
Palantir is generating higher profits at a faster rate than revenue growth, unequivocally proving their scale advantages.
Plus, that operational efficiency translates directly to the balance sheet. Palantir ended the quarter sitting on $8.0 billion in cash, cash equivalents, and U.S. Treasury securities, while carrying zero debt. They delivered an adjusted free cash flow margin of 57%, which means they generated $925 million in a single quarter. This is a fortress balance sheet. It provides total immunity to higher capital costs and gives them infinite runway to fund continuous AI innovation without ever diluting shareholders.
Section 2. Actionable frames, swing trader versus long-term investor. The tension between a crumbling stock chart and an accelerating business forces the market into two very distinct strategic frameworks. How you interact with Palantir right now depends entirely on whether you are managing near-term volatility or betting on structural AI durability. The swing trader framework must respect the extreme PE multiple compression as the primary key risk. For short-term capital, the focus is strictly on trading around that $11-12 and 10-cent 52-week low, which remains highly sensitive to the bearish momentum currently dominating retail sentiment. Conversely, the long-term investor framework evaluates the structural moat. Their downside protection is the $8 billion in cash, zero debt, and a massive 150% net dollar retention rate. Long-term capital is focused on institutional modeling of the enterprise AI boom through 2030, essentially ignoring the immediate multiple compression.
Speaking of institutional modeling, Ticker's base case valuation projects a $985 price target for Palantir by December 2030. Now, this model builds in an 8 to 10% per year multiple compression across all scenarios. It fully assumes the premium valuation is going to deflate. However, it still projects massive upside driven by a 53% EPS compound annual growth rate. Even with the multiple shrinking, if Palantir just maintains its current trajectory of earnings growth, the model implies a 622% total return over the next 4.5 years.
If you want bull versus bear stock analysis without hype, subscribe to Future Ready. Section 3. What matters next? The upcoming Q2 catalyst. Institutional models looking out to 2030 are definitely compelling, but Wall Street is hyper-focused on the immediate horizon. The upcoming Q2 earnings event will serve as the primary catalyst. It's the trigger that will definitively dictate the stock's next major price movement and determine if this current valuation can be defended. Management has set incredibly precise parameters for the second quarter. They're guiding for total revenue between $1.797 and $1.801 billion. But crucially, they expect adjusted income from operations to land tightly between $1.063 and $1.067 billion. With Wall Street consensus expecting an EBITDA margin of roughly 61%, Palantir has essentially boxed itself in. They must hit these exact operational targets to prevent further severe multiple compression. Flawless execution is no longer a bonus, it's the baseline expectation. Ultimately, the entire Palantir thesis right now hinges on a single vital question. Can U.S. commercial revenue sustain growth above 120%? Management has guided for exactly that, at least 120% growth for the full year 2026 in that specific segment. If U.S. commercial revenue holds that line and approaches $700 million next quarter, it forces a Wall Street re-rating, confirming the durability of the AI infrastructure boom once and for all. But if it decelerates, the market will aggressively decide that Palantir's AI multiple is simply too heavy to carry. Watch that U.S. commercial number. It is the absolute center of gravity for this stock. So what do you think? Is the multiple finally matching the reality, or are we staring at a sandcastle about to wash away?